Hi, everyone, and welcome back to another episode of the Optimized Wealth Podcast. I'm Lance Norquest, investment advisor with Bellwether Wealth, joined by economist Alan Beaulieu. Today, we're focusing on international equity markets, what they are, what they've been doing, and how they've been performing, but also what investors should be thinking about going forward. Now, Alan, obviously, international can mean a lot of things to a lot of different investors, and it's pretty easy to just kind of lump everything into one bucket, if everything outside of the US into one bucket. And
Yeah.
so maybe before we dive right in, maybe we should talk about how we break it down, from your framework. How do you typically frame up international markets when you're looking at just global economy?
No, it makes a lot of sense. And you're right. It's like thinking Europe is one entity. It's not, right? It's quite varied. So,
Right.
uh, uh, without diving into a lot of detail, because we don't want to bore people to death with a bunch of statistics, what I have found interesting is that uh, here in the United States, we tend to project that to the rest of the world, think, well, if we're feeling pretty good, then probably the rest of the world's feeling pretty good. And we're missing pain in things going on in other countries. Now, quick broad metrics I look at, the US dollar. If the US dollar is being ignored by the rest of the world, that's telling how the world feels about it. They're angry with us or turning towards brick or something else. But so far it's been stable since, for the last half year, it's gone up a little, down a little, but it really was at a bad point in 25, then it came back down and it's still okay. So that tells me the world's pretty okay with the United States, and that's good for our economy, and it means the global economy is not angry with us. The World Uncertainty Index has gone up and down. It's still well above anything we saw prior to 2025. In 2025, it shot up like a rocket, came back down, but not nearly down to where we were. So the world is still feeling very uncertain, which makes me want to look into why. Well, why is not hard? Iran is part of it. Before that, it was the trade tariffs and all the rest of that. There a lot of instability has been introduced into the world. So we peel back that layer and go, who's feeling the pain? Well, the people feeling the pain are who you would expect. It's China, and they mask it well, but there's concern in China. Japan's got a lot of concerns going on right now. South Korea and most of the rest of Asia is feeling pain because of oil and because of uncertainty, and they're wondering about stability in the world. So their economies are nowhere near a recession, but they're nowhere near we're ready to grow and go that we thought they would be, or I thought they might be. They're going to grow and they're going to go, but they're going to go so at a much slower pace than probably we anticipated a year ago, because of the political and economic uncertainty that exists out there. Is it bad news? No, that's too harsh a word, bad. Does it hurt profits some? Sure. Does it create investment uncertainty? Well, they look for the best investments under those circumstances, as opposed to abroad, right? At least I would.
Sure.
I would not be in a hurry to run to some nations now with my investments. I'd go with the ones that are larger and safer. Which leads us, I think, to you nicely, is to, how are they doing? And I know we've talked about it, but let's share the wealth of your knowledge with how they're doing in this mixed up, uncertain world.
Yeah, mixed up and uncertain. I couldn't agree more. Um, again, international really came into the spotlight last year from an investment standpoint, because previous to that, in the most recent years, the US market has just been a dominant player. And it's really primarily due to the concentration of the mega cap tech companies, or these large cap. Magnificent Seven is another term used. Um, so last year in 2025, we saw quite a bit of volatility around tariffs. And some of that volatility, it kind of fueled some changes in investors, both institutional as well as retail investors, on kind of what we were seeing. So we did start to see a little bit of a change in investor sentiment and positioning. So, for example, everyone largely was pretty concentrated again in US markets, but especially in these mega cap tech companies, and have been for years. But what we started to see is in the the tariff volatility probably fueled this, is we started to see a broadening exposure from an investor standpoint into global investments. And with that broadening exposure and in picking up some of these international investments, what we also saw last year was a broadening of market participation. So again, the US markets were still very narrow, again, picking on those top 7 or top 10 names, whereas international markets, they're less concentrated and they're more broad. And we saw a broader approach or a broader participation in the market. So another reason why we saw them perform so well last year. And Alan, you mentioned U.S. dollar weakness. From my view on looking at international, it's almost considered a tailwind, if you will, for international investment because as you know, the U.S. dollar weakens, it almost amplifies any international investments just due to that foreign currency strengthening against the U.S. dollar, rightfully so.
Sure.
So as we look at 2026 and beyond, I know there's some uncertainties and some concerns on maybe certain countries over others. But what are some things that we're watching right now and why we still think that international might still be favorable to add into the portfolio? And one of those things is just a simple valuation gap. Again, it was last year, it's this year, we've been hearing it for several years. US stocks are just generally more expensive, and they are more expensive than the rest of the world. If we quickly look at the cyclically adjusted price to earnings ratio or CAPE ratio, or others have maybe heard the Schiller ratio, it does favor international. So it's allowing investments, internationally to get valuation discounts, and there's higher implied returns given the risk associated with the investment. So it does actually somewhat signal a better opportunities abroad relative to just being concentrated in US markets. We're also looking at just equity diversification opportunities here too. So again, I keep saying the same things, but the reality is true that most investors were heavily concentrated and still, for the most part, in these mega cap tech companies. Even if you're holding the S&P 500, that is still a concentrated position in these big
Sure is.
names. So this creates really a good opportunity to kind of divest from that US concentration and kind of balance your equity exposure and kind of take advantage of some of these favorable conditions. Again, there's always going to be some of that uncertainty on, oil and the Iranian conflict and things. But again, from a metric standpoint, we do see that this diversification shift, it can be beneficial for your equity portfolio. Now, I think it's also important to mention, though, that we don't see this necessarily as we're bearish on the US markets by any means or US equities. I would look at this as simply a diversification play or a shift in the portfolio, not necessarily a hedge against US markets.
I think that was extremely well said. I'm going to use an adjective though that I don't think you would use, but even as an economist, I would use it. I'm excited about the inclusion of the foreign exchanges and the potential there for some additional alpha and some lift. When we first started talking about that, looking at that, I don't get giddy because I'm an adult economist, but I got, yes, this is good. And which, to your point, doesn't mean I was anti-US markets, but it was like, this is an exciting opportunity. And it's got to be measured, as you would quickly say, and it's got to be appropriate, but it was like a ray of sunshine when all I was doing was living in the shadow of the Magnificent Seven. And it was nice to be able to get that diversity, that broadness that you're talking about, because that's where I'm more comfortable. Picking the one rocket makes me nervous. A broader investment portfolio it makes me much happier, and this offers it. And the world is saying we shouldn't be overly concerned about all of a sudden it crumbling either. Now, having said that, the economy and the stock market, no matter what the country, are not tightly correlated, but at least from my perspective as a simple economist, I'm not seeing any major storms that should disrupt people's opinions or outlooks for their economies.
Yes, volatility is a normal part of investing in stock markets. So one can always expect it. But again, I agree, not really seeing any, it's pretty low global recession risk at this point from what we've seen. So again, kind of just um, fuels the opportunity, if you will, to again diversify your equity portfolio and to add more of that international exposure to kind of broaden yourself against the more concentrated U.S. markets. But that said, how do we get some of this international exposure maybe into our portfolio? And there are several ways to do it, of course. One is you could simply just go buy the individual names or individual stocks. I mean, you can go on the foreign exchanges. That's easier said than done.
Yes.
There are there's some options in the U.S. market or U.S. exchanges. They're called American Depository Receipts or ADRs, which essentially is it allows a non-U.S. corporation or entity to be listed on a U.S. exchange or a U.S. market, and then you can buy and sell them in U.S. dollars. And some common examples of these are the automaker Toyota, the electronics producer Sony, and the energy corporation BP are some good examples. Another way to approach this is also just through the form of ETFs or exchange traded funds, as well as mutual funds. The nice thing is you can use these different funds to invest in, the developed markets or emerging markets. You also can even get further granular, if you will, and look at regional exposure, whether you're looking specifically at the Eurozone or Latin America or the Pacific/Eastern Asian geographical region. And you can even find some that are country specific. So if you're looking for something specific to Japan or China or United Kingdom, there's a lot of different options available there too. Now, something to keep in mind though is if you are looking to invest internationally, again, whether you're looking at regional, country specific, or developed versus emerging, you'll want to make sure you understand the exposure that you have in the underlying regions or countries, because if you're overly exposed to one country over the other, it could put unnecessary exposure to currency and or geopolitical risks in the portfolio there. And some of these funds even exclude certain countries, like China, for example. There are Eastern Asian funds that exclude China. And likely some of those reasons being, geopolitical risk and other
Right.
factors. China is actually considered an emerging market, although they are the second largest economy in the world. And while they do check off a number of boxes associated with being a developed market, they're not quite there. Any thoughts on why that might be, Alan?
Yeah, the world's a silly place. That's my thought. Because some things just don't make sense. You
Yeah,
may
I
have a
mean,
more serious answer, but to me, it's like, that's dumb.
yeah, so your developed ones are obviously going to be your highly industrialized economies, strong infrastructure, things of that nature, where your emerging markets are going to be, as the name implies, they're emerging. Their infrastructure is still developing. And when I mean infrastructure, it's not just your transportation and roads or your energy or utilities. I mean, we're talking healthcare, your education system, uh, your financial structure as well as a country too. But the reason why China maybe doesn't check all the boxes as a developed country, although it is a very large powerhouse when it comes to global economy, is their government still plays a strong role in the banking system. There's uneven development across the country. So Shanghai is obviously a very developed city, um, but when you start to get to the rural areas, not so much. And then another thing that's associated with these developed countries is going to be higher levels of income. And China is still kind of in that mid-range compared to other developed countries. So,
Yeah. I hear you the strict rule there, but as far as the rule part goes, that's by design. And the banking system's by design. So I'm not arguing with you. I'm just going back to my, fine, label it what you want, but China is a powerhouse and it carries its own risk. Um, that's all.
yeah,
I don't like
no,
calling it an emerging country because that to me puts other emerging countries in a bad light, or inferior.
yeah, I don't disagree with you. Again, I think that's why you see different funds. If somebody is really focusing on emerging markets, especially in that particular Eastern Asian region, that's why you probably see some of these funds. Some will include and some will exclude China just because of what the investor is trying to accomplish with their allocation. So
Yeah.
definitely see both sides of the coin there. For anyone that has questions, they can definitely reach out to our office. Our phone number is 402-476-8844. Or obviously, we have a chat feature on our website at bellwetherwealth.com if you have questions on how to apply international investments to your portfolio. But Alan, you had another thought.
Just that my takeaway from today is you presented that there's a lot of opportunity here. And that's always a good thing for the investment world. And you're presenting not a wild opportunity, but a good measured opportunity for people to look into that might be very worthwhile.
Yeah, no, at the end of the day, again, we've been hearing the US markets are overpriced for several years, and this is just another way to diversify your equity portfolio by adding another opportunistic asset class to, to provide that extra alpha over and above or performance in your portfolio.
Absolutely. Good talk. Good time.
Absolutely. Well, Alan, pleasure. Um, For those listening, that is all for today's episode. Appreciate you joining us. I'm Lance Norquest with Alan Beaulieu, and we'll see you next time on the Optimize Wealth podcast.